You ask, we answer. Welcome to the BiggerPockets Hotline. Today we are talking about the elephant in the room of investing right now, and that is cash flow. And our BiggerPockets YouTube community is feeling the pressure, guys. We're about to tackle the most common pain points for you and help you all make the right decisions for your investing circumstances. What's going on, everybody? Henry Washington here, your favorite BiggerPockets personality. I have been investing in real estate since 2017. I have amassed a portfolio of over 100 rental units. And I think that helps me qualify as somebody that should be talking to you about this pain point, which is cash flow. So not only are we going to talk about how to get the cash flow you're looking for, but we're going to talk about how to fix some of these other issues that are tied to why you're not finding cash flow right now. But before we get into all that, are you tired of coverage gaps that come with one-size-fits-all insurance policies? At National Real Estate Insurance Group, every investment property has a perfect fit. NREIG's program for real estate investors offers fully customizable coverage for all phases of occupancy on one monthly schedule and bill. Break free from the constraints of generic insurance policies. Request a proposal at nreg.com/BPYT. That's NREIG.com/BPYT to get started today. So BiggerPockets recently polled its audience, and we asked, for current investors, what is your biggest challenge with cash flow? And the results came back as follows. 61% of you said that loan rates are too high, and that's what's causing the cash flow issues. 14% said that rent comparables are just too low for profit. 13% said my other monthly expenses are too high. So that includes your management fees or your taxes and insurance and other ancillary costs that go along with your mortgage payment for a rental property. And 4% of you said, I have too much vacancy and I can't find tenants. So let's address some of these things right now. Let's start off with the one that everybody says, which is that loan rates are too high. So interest rates are too high that you can't cash flow. What if I told you that every property cash flows? Every single one. Well, Henry, how does every property cash flow? I can't find any cash flow in anything that I'm looking at right now. You're right. You can't find cash flow in anything that you're looking at right now. And what you're looking at are properties listed on the market. And what you're offering is typically the price that that person is asking for that property. Maybe you're offering a little bit less, but every property cash flows at the right price. The difference is most people aren't willing to make offers on the properties that they want at the price point where it does make sense for them to cash flow. You have to remember that when you're looking at a property that's for sale, or when you're going direct to seller and you're talking to a seller, there's the number that they want and there's the number that you're willing to pay. And most people know that they can't pay what most people want. So they know the number that they're willing to pay, but they're too embarrassed to make that offer because it's probably substantially lower than the number that they're asking. And so we have to get more comfortable making our offers at the price point that it makes sense for us. This is a volume game and a numbers game, and you never know why someone might sell their property at a discount. I think that's what people want. They want to hop on the internet. They want to hop on Zillow, Redfin, the MLS. They want to find a property. They want to make an offer at what it's listed at, and they want that thing to start producing cash flow. And those days are behind us right now. You could do that maybe 5 years ago, but doing that right now is not easy to do. It's going to take a lot of effort. It's going to take analyzing tons of deals, and it's going to take making tons of offers. Because if you make 100 offers, you may only get a counter offer on like 10 of those, right? And so that's a lot of work to get 10 counter offers, and then you still may not land at a price that makes sense for you. But that's the level of effort that it may take for you to find cash flow now. I don't suggest you just go out and start lowballing people and then not providing any reasoning for why you're doing that. So when I do this, especially if I'm direct to seller, what I'll typically say is, hey, I see you want $300,000 for this property. I totally get it. I think if you can get $300,000, you absolutely should. I am an investor and I have to buy a property at a price point where it makes sense for me to be able to add value to this property by fixing it up if it needs it, and then to monetize that property by either renting it out or selling it at a profit. And unfortunately, that means I can't pay retail value for these properties. And so what I can do is tell you what I would be able to pay and explain to you why, and hopefully that makes sense to you. And so then I will do that and I will back into it and I'll say, hey, Mr. and Mrs. Seller, I see you want $300,000. Well, if I buy this property, I'd probably looking to turn around and sell this property for $300,000. And if I'm going to sell it for $300,000, that means I got to pay an agent 6%. That means I have to pay closing costs twice, both when I buy it and when I sell it. And that means I have to pay the cost that it's going to cost me to renovate it. If you add all those fees up, that's $50,000 right off the top. And then if you take off that 50 grand or 60 grand or whatever that number is, I still need to be able to make some sort of a profit. So if I want to make $20,000, $30,000, I subtract that right off the top. So now we've got $70,000 to $90,000 right off the top of that $300,000 profit. And so my offer would fall somewhere $90,000 less than what you have asking. If that's something you're interested in, I'd be happy to submit an offer. If not, no big deal, right? But now at least you shot your shot and you've explained why you're doing it. So they don't just think you're throwing out some random number trying to steal their property. What you're doing is you're saying, this is what I can pay and this is why I can pay that. And if that makes sense for you, that's great. I'd be happy to make that offer. And if it doesn't, that's great too. And you can move on to the next one. But the people who are willing to do this amount of work for every single deal that they're analyzing are the ones who are going to get the deals. And the people who just want to find a deal online that makes sense are going to continue to say, I can't find any cash flow right now. So you have to decide, are you willing to do the work? You have to decide if you're willing to get a little uncomfortable. And you have to decide if you're willing to make these kinds of offers. The next is rent comparables are just too low for profit. Well, rent comparables are what they are, right? What people are willing to pay for rent is going to be market specific. And so again, I think it ties to, if you know what people are willing to pay for rent, then you have to understand how much you're able to pay for that property in order for those rent numbers to work. I think you're going to find a lot of these answers are going to be tied to how you underwrite your deals and what price point you're willing to offer for these properties. And if you can't find these properties by just going online, then you have to go start trying to find these properties by going direct to seller and manufacturing your own deals, or you have to get a little creative with how you are looking to create rents. And so yes, if rent comparables are too low for profit, maybe that means traditional long-term tenant rent is too low for profit. But what if you could do a midterm rental strategy where you do 30-day stays? Or what if you could do a rent by the room strategy where you're renting each room out individually and taking either weekly or monthly rent per room? Those strategies increase the amount of rent that your property is producing, and then that helps you create cash flow by being creative about how you're monetizing the rents in your property. You can also do some small things like doing value add projects that don't cost a lot of money, but they add perceived value to your property. So in all of our rental properties, we make sure we put a nice backsplash in the kitchen. We make sure we do tile surrounds around the tubs. We do the things that a lot of landlords don't do, because when people are looking at properties, they will fall in love with our property because we have nicer finishes, and we just try to choose materials that aren't too expensive, and we really work hard to find labor that isn't crazy expensive. So we can do some of these upgrades to our properties at a minimal price point, but then when people walk in and see that they get tile surrounds in the bathroom, tile backsplashes, nice LVP floors throughout the whole property, there's a cohesive, consistent look. It's repainted. It looks really, really nice. We make sure we paint the cabinets. We put granite countertops in all of our rentals. And so people see these things, and it may not have costed us a ton to do these upgrades versus what most landlords would do, but people then like our property more. And that means they're either willing to pay us more, or we're going to get more volume of tenants applying for our property. Because if somebody's looking at 5 properties in a day, ours is going to stand out because it's going to have the nicer finishes, and hopefully that means we get more applicants and have more opportunity to get better rents. The third point, my other expenses are just too high. Well, I mean, yeah. Insurance is going up all across the country, and so that is going to be an increased cost. Management fees can be expensive if you're hiring property management. And so again, same thing here. This is all part of your underwriting. You want to make sure that you are considering these higher fees when you're underwriting your deals and when you're considering what your offers need to be. But there are some things you can do to reduce those expenses. And so I would talk to your local cities or municipalities and see if there's any types of credits you can get for any of these things. Some areas are offering different tax credits for some of the things that maybe you have in your property, and maybe for energy efficiency. And so do some research and figure out, are there some discounts I can get on some of these things if I put certain things in my property, or if I offer the property to rent for certain tenants? But it's going to require you to do some research and some local research to figure out, are there ways that I can get discounts on some of these things? Also, talk with your management company. If you have a property management company who's doing some of these things for you, maybe they can offer you a discount because you've been a longstanding customer, or maybe once you get a certain amount of doors, they can discount your percentage because now you have more units under management. But you want to understand, what are all the ways I can do to reduce some of the expenses I have in my properties? The more you reduce the expenses, the more your cash flow is going to increase. All right, next on the list, there were several comments of people talking about having trouble finding good tenants or avoiding bringing in professional tenants into your properties. And this is an issue for landlords, but what it boils down to to is you. How good are you at selecting tenants? What processes and procedures do you have in place for ensuring that you select good tenants? People have been renting properties since the beginning of real estate. And so you don't have to reinvent the wheel on how you find good tenants. You just have to do some research, figure out what other investors are doing who are successful landlords, and then implement those processes and procedures into your tenant selection process. This goes for either you managing your own tenants or you finding a property manager who finds tenants the way that you would like them to find tenants. You need to ask your property managers that you're working with what are their process for finding good tenants. Because just because you hire a property manager doesn't mean they're going to be good at finding good tenants. So you need to understand how to find good tenants so that when you talk to your property manager about how they find good tenants, you can understand if they're doing a good job at finding good tenants as well. But this is a responsibility that falls on us. And so I'll tell you what I look for when I'm trying to find a good tenant. The first thing I'm looking for is, do you make enough money to afford to live here? And so typically I'm looking for someone to make 2.5 to 3 times the rent in their gross monthly pay. So if the rent is $1,000 a month, I want them making $2,500 to $3,000 a month gross. That is just a good indicator to let you know that this person potentially can afford to live in this property. The second thing I'm looking for is I want to understand why this tenant is moving. A lot of times tenants are moving because maybe they had a problem at their previous property paying rent and they're moving out so they don't get evicted. You want to be able to uncover some of these things. And that means you need to start asking some questions. You need to ask them, hey, why are you looking to move? They'll give you an answer on why they're looking to move. And then you need to verify that. And so always call the last 2 previous landlords. Because if you just call the one previous landlord, they may want this tenant out so bad that they'll tell you anything about this tenant to get them out of their hair. But call 2 landlords back and see what that landlord has to say about this tenant. You will be shocked at how many landlords don't call their previous landlords or don't call the references that are provided. And then I also like to call employers. And when I call employers, I'm looking to ask questions like, hey, does John or Jane Doe come to work on time? Do they cause problems at work? Are they enjoyable to be around? Do other people enjoy working with them? If you had a property and they wanted to live in your property, would you let them live in it? These questions will help you get some insight into, is this person going to be a tenant who takes care of my property? Is this person going to be someone that I enjoy interacting with? Is this person going to be someone that is going to be a headache or a problem? Because if they're a headache or a problem to their boss, they may probably be a headache or a problem to you. And so make sure you have a process in place for how you evaluate and find out more information about your potential tenants that maybe just doesn't come across initially on an application. And then also I am going to do credit and background checks, and I'm not doing credit and background checks just to rule out anybody who has a criminal past or to rule out anybody who has a low credit score. Here's what I look for with credit and background checks. In respect to credit, I am not looking for the score per se. I am more looking to see if the score is low, what's causing the score to be low? Because there are a lot of things that can cause your credit score to be low that doesn't have a bearing on how good of a tenant you might be. For example, if somebody's credit score is low because they have lots of medical debt, well, medical debt's expensive in this country, and a lot of people can't afford to pay their medical bills. That doesn't mean that they aren't going to pay their other bills on time. And so I'm often willing to overlook high medical debt issues because we can all find ourselves in that boat. Also, a thing that doesn't really deter me is recently divorced. Divorces can destroy your credit. And a lot of people have found themselves in divorce situations, and that doesn't mean you're going to be a bad tenant either. And so if your credit is bad because of that issue, that's something that I'm willing to overlook. Some of the credit issues I'm not willing to overlook are the things that you have collections on that are bringing your score down? Are they related to your normal life issues like your utilities and your phone bill? If you're not paying your utilities or your phone bill, there's a high likelihood you're probably not going to pay your rent either. So those are some red flags for me. But in terms of all of the other issues, you have to look at credit as a whole and determine what's causing the credit score to be what it is. And then you can make a better determination if this person is likely to pay their rent or not. In terms of background checks, I'm not necessarily looking to see if you have any criminal past and then weeding you out. That is not the case for me. What I'm looking for is to see if you do have some criminal past, well, what was the issue? How long ago was the issue? Because one of my best tenants right now is a convicted felon. He had a nonviolent drug charge. He served 14 years in prison, and now he lives in one of my units and is the best tenant I've probably had in a long time, pays on time, every time. And he was very appreciative of the opportunity to find some place to live because a lot of people were just weeding him out based on the fact that he had a criminal past. So at the end of the day, it comes down to you being a good landlord who is good at tenant selection. There are several books within the BiggerPockets ecosphere that you can look to learn more about how to evaluate tenants. But this is something that you have to get good at if you're going to manage your own properties. And if you're not going to manage your own properties, then you need to at least understand how to do this well so that you can evaluate the property managers that you use to evaluate your tenants. All right, the next user question is, my stumbling block is my DTI. And what I'm assuming this means is you're having trouble getting loans because banks are telling you that your debt to income ratio is too high. So your debt to income ratio is just a measure that lenders use to determine how much debt you have versus how much income is coming in. And they want to see a positive number here where your income is higher than your debt. So we know you have enough money to service the debts that are coming in. And so as you start to buy different things in your life, cars and other expenses, those are things that are costs that you're taking on debt for, and how much money are you making to cover all of your debts. And so when people say my DTI is what's stopping me, oftentimes what that ties back to is A, yes, that's real and a bank is telling them that, or B, it's not real and a bank hasn't told them that. Because sometimes people just feel like, look, I know I have a lot of debt and I know I don't make a ton of money, and so my DTI is not great and I probably won't get qualified for loans. So first and foremost, don't just assume your DTI is not good. If you're trying to buy a property, go and talk to a lender. Said differently, go and talk to several lenders, because every lender is a little bit different and every lender may have a different lending box and every lender may be more comfortable with one thing versus another. And so don't just talk to one lender and that lender says, well, your DTI is not good enough for us to lend to you, and then just think you're unlendable. That may not be the case. Sometimes you have to shop around and find other lenders who may be willing to work with you in your current situation. But you have to know what your current situation is first. And that means you're going to need to talk to some banks and hear, is this really a hang up for you? And so now let's play in the space where we just determine that, yes, this is actually a problem for you. So if you fall in that boat where you understand, yes, my DTI is actually holding me back. Well, typically that means your DTI is holding you back from getting probably conventional lending, because that's really where DTI comes into play most. But we have to realize that conventional lending isn't the only way to get investment properties financed. There are multiple ways to finance investment properties. What you want to do as a real estate investor is become a fundamentally sound real estate investor. And that means you need to go out and educate yourself on what are all the ways I could potentially finance a deal. And then you want to put together the financing that fits your deal the best and your financial situation the best. Where those two things intersect, that is the financing that you should be using for your deal. And so if your financial situation includes you having a high DTI, well, that means conventional lending probably isn't the best option for you. And so I would encourage you to look at some other types of lending options. You could potentially look at leveraging small local banks. Small local banks are going to care about the asset and you and your financial situation. And so your DTI doesn't come into play as much as it does on a conventional loan. Your deal is going to come into play here as well. You could shop around for some commercial loan options for getting your deal done. You could also look at other options like a non-QM loan or a non-qualified mortgage. These loans are made for people who don't fit in the traditional lending box. And so they may be willing to work with your higher DTI because these loans are made for situations like that. There are tons of options out here. These are just a few of the ones that you can look into on its surface. I talk about tons of these lending options, and I try to teach you how to be a very fundamentally sound real estate investor in my new book, Real Estate Deal Maker. And you can get that new book, Real Estate Deal Maker, where we teach you how to find and fund real estate deals at biggerpockets.com/dealsbook. So in conclusion with this, you need to educate yourself. What are all of the loan options? And then look for loan options that fit people who have a high DTI. There are tons of investors all across the country with high DTIs who are doing real estate deals. So surround yourself with more investors as well. Go to your local meetups and start asking people how they're getting their loans financed. I guarantee you, you're not the only person in your local market with a high DTI who's doing deals. Find out who they are and what they're doing and see if those options work for you as well. All right, guys, hopefully you've got some new ideas for how you can find cash flow in today's market. And hopefully you learned some information that's just going to help you be a better real estate investor all the way around. And if you want to calculate deals or play around with the numbers to find what works for you, you can check out the BiggerPockets calculators, as well as if you want to learn more about how to find great deals and find funding for great deals, you can check out my book, Real Estate Dealmaker. You can also connect with me on BiggerPockets, or you can check me out on the Real Estate Podcast or the On the Market Podcast. Until next time, thank you very much for joining me. I hope you got great value. If you did, click the like and subscribe button below so we can keep bringing you great value like this. And as always, I'll see you at the closing table.